Welcome back, future CMAs. I am so glad you're tackling this section today. In this explainer, we're going to master one of the absolute cornerstones of financial statement analysis on part 2 of the CMA exam, liquidity ratios. Now, having helped countless students prepare for this certification, I know for a fact that the ICMA absolutely loves testing this topic. And why is that? Well, because liquidity is the ultimate pulse check on a company's immediate survival. So let's dive right in and uncover this together. Okay, before we touch a single math formula, we really have to ask kind of a dramatic question. Can we pay our short-term obligations literally right now without going under? These are the exact stakes of liquidity. We aren't looking 5 years down the road right now. We are looking at tomorrow. If a massive financial shock hits, will the business even survive the week? Understanding this immediate survival stake, that is the key to unlocking every single ratio we're about to cover. All right, let's get the formal definition out of the way. Liquidity is a company's ability to pay off its short-term debts as they come due, which typically means within the next 12 months or within one normal operating cycle. Now, I really want you to contrast this with profitability. A company can be wildly profitable on paper, but if all its cash is locked up in machinery and payroll is due tomorrow morning, well, they're in deep trouble. Profitability is a long-term game. Liquidity is what keeps the doors open today. So here's our syllabus for today's explainer. First, we'll cover what liquidity actually is. Second, we'll look at the spectrum of strictness. Third, quality over quantity. Fourth, we'll go over some sneaky exam traps to beware of. And finally, number 5, a quick exam day review. Starting off with section 1, what is liquidity? It really boils down to survival versus profitability. Think of this as a stark line in the sand. On one hand, you have profitability. That's what keeps you alive in the long run, right? You obviously need to make more than you spend eventually, or you just disappear. But on the other hand, you have liquidity, which is what keeps the doors open today. It literally doesn't matter if you have $1 million in guaranteed profit coming 3 years from now if your main supplier cuts off your inventory shipments tomorrow just because you couldn't pay today's invoice. The ICMA tests liquidity so heavily because it completely separates theoretical financial success from practical, everyday business survival. Moving right along to section 2, the spectrum of strictness, where we'll introduce the 3 key ratios. Let's start broad. We're talking about the current ratio. This formula compares all of your short-term resources against all of your short-term debts. So if you have a current ratio of 2.0, that simply means you have $2 of current assets for every $1 of current debt. Now, generally speaking, a higher number is safer, but as feature management accountants, we have to look a little deeper. If this ratio is way too high, it might actually be a huge red flag. It could mean management is just hoarding idle cash that should really be invested, or worse, they're just sitting on a massive mountain of unsold inventory. And this perfectly illustrates why we need a stricter test, because not all current assets are equally easy to turn into cash. While the current ratio includes absolutely everything, the quick ratio, which is notoriously known on the exam as the acid test ratio, gets much stricter. It actively strips out inventory and prepaid expenses entirely from your asset pool. Now, you might be asking yourself, well, why exclude them? Why is the acid test so ridiculously strict? It's pretty simple when you think about it. Inventory requires a sales transaction to actually turn into cash. And sometimes it takes months to find a buyer. And prepaid expenses like, say, prepaid insurance or rent, those yield a future service. You can't just call up your landlord and say, hey, I really need to pay my supplier. Can you just refund my prepaid rent? It just doesn't work that way. The quick ratio only wants assets that are already cash or are rapidly, almost instantly on their way to becoming cash. Okay, but what if a crisis hits right this very second? That brings us to the absolute most extreme end of our spectrum, the cash ratio. This measures immediate, drop everything else solvency using only cash and near cash equivalents, like marketable securities. And notice what we deliberately excluded here. Accounts receivable. Why? Because in a severe real-world crisis, your customers might just default, or they might aggressively delay their payments to protect their own liquidity. Basically, the cash ratio trusts absolutely no one. So if you look at how this spectrum of strictness visually narrows as we move down the list, current includes everything. Quick drops inventory and prepaids. Cash drops accounts receivable too. I want you to burn this framework into your memory for exam day. It is honestly the ultimate cheat sheet for remembering exactly what goes into the numerator of each equation. Let's jump into section 3. Quality over quantity, focusing on net working capital and the operating cycle. On the exam, you aren't just going to be tested on ratios, you'll also be tested on net working capital, or NWC. And it's really vital to clarify the difference between the two concepts. Ratios, as we've seen, just provide a proportion. They tell you the mathematical relationship between two numbers. But net working capital, that provides a raw total dollar amount buffer. It's just your current assets minus your current liabilities, giving you the actual literal cash cushion you have to operate your business day to day. To prove exactly why we need to understand asset quality, let's do a quick challenge. Picture two completely different companies. Both Company A and Company B have a current ratio of exactly 2.0. So on paper, they look identical, right? But let's dig a little deeper. Company A holds mostly cash and accounts receivable that they collect in a brisk 15 days. Company B, however, holds mostly slow-moving, obsolete inventory and receivables that take a painful 120 days to collect. So which company is actually more liquid? It's Company A, hands down. A high ratio doesn't automatically mean good management if the assets making up that ratio are practically frozen in time. And that leads us straight to our golden analysis rule. The ICMA wants us to know, deep down, that liquidity is tied directly to the operating cycle and the cash conversion cycle. We can never just look at a raw number and call it a day. We always have to evaluate the quality of those assets and their turnover speed. How fast does the inventory actually sell? How quickly do those receivables actually turn into spendable cash in the bank? That is what true liquidity analysis is all about. All right, Section 4. Beware these exam traps. Let's get into the test maker's favorite tricks. Trap number 1 is a total classic math trick, the equal increase/decrease effect. Let's walk through the math together. Say we start with a current ratio that's greater than 1.0, for example, $200 in assets over $100 in liabilities. That's a solid 2.0 ratio. Now, management decides to use $50 in cash to pay off $50 of debt. So they've reduced both the numerator and the denominator by the exact same amount. Our brains naturally want to think the ratio just stays the same, right? Wrong. If you look at it, we now have 150 in assets over 50 in liabilities. Our new ratio just jumped to 3.0. The core trick to remember here is this. If your starting ratio is greater than 1, subtracting equal amounts will actually make the ratio go up. Trap number 2 is sneaky, because this is where they love to mix topics just to test your overall accounting knowledge. They absolutely love mixing inventory valuation methods with liquidity ratios. Picture an inflationary environment where prices are steadily rising. If a company uses LIFO, last in, first out, the older, cheaper costs are what's left on the balance sheet. That means lower inventory value, which obviously means lower current assets, which mathematically results in a worse current ratio. But if they use FIFO, the newer, higher costs are sitting on the balance sheet, which inflates the current ratio. Be incredibly careful when a question mentions both liquidity and LIFO or FIFO. We're going to conquer these together so you aren't caught off guard on exam day. And trap number 3, that involves factoring receivables. This is when a company desperately needs cash, so they go and sell their accounts receivable to a third party. The trap here is thinking that this action drastically changes the quick ratio, but it actually doesn't. Think about it. Cash goes up, but accounts receivable goes down by roughly the exact same amount. You are literally just swapping one quick asset for another quick asset. The mathematical ratio remains relatively unchanged, even though, practically speaking, the company's immediate cash availability just got a whole lot better. Don't let them trick you into selecting a multiple-choice answer that says the quick ratio skyrockets. Finally, Section 5, Exam Day Review. Let's lock this knowledge in for good. Okay, so here's your essential checklist. Take a mental snapshot of this right now. The current ratio includes all current assets. The quick ratio explicitly excludes inventory and prepaids. The cash ratio strictly uses only cash and marketable securities. When analyzing any of these numbers, always assess the quality of the assets and how fast they actually turn over. And finally, keep your eyes wide open for that mathematical trap we talked about. Watch out for equal changes to the numerator and denominator. Now, as your teacher, I'm not going to just let you walk away without a little bit of homework. Here's your action item for today. I want you to go practice 10 to 15 multiple-choice questions specifically focused on liquidity ratios. Don't wait until tomorrow. Doing it right now will permanently lock this knowledge into your brain. We've uncovered the core concepts here, and you have all the tools you need to completely dominate this section of the test. You've absolutely got this. But hey, before we wrap up, I want to leave you with a thought that takes this right out of the exam room and into the real world. Forget the CMA for just a second. If a massive financial crisis hit the market this afternoon, what is the quick ratio of the company you work for right now?
Do they actually have the cash to keep the doors open? It's a pretty fascinating question, isn't it? Apply what we've learned here to the real world, and I promise you'll be a far better management accountant for it. Thanks so much for joining me for this explainer, and I'll see you next time.